wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 197, and in this episode we're reviewing the performance of the financial markets during the fourth week of 2026, and that is from Monday the 26th to Friday the 30th of January. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the United States, where on Wednesday, the Federal Reserve voted to take a break from a recent run of interest rate cuts as the central bank navigates questions about its independence and awaits a new chairman. Meeting market expectations, the central bank's Federal Open Market Committee voted to keep its key policy rate in a range of between 3.50% and 3.75%. This decision put a halt to 3 consecutive quarter percentage point reductions that were implemented in order to guard against a potential downturn in the labor market. In voting to hold its policy rate, the committee raised its assessment of economic growth and eased its concerns about the labor market, but remained cautious about inflation, which remains somewhat elevated. Staying in the United States, on Friday, President Trump named Kevin Warsh to succeed Jerome Powell as the Federal Reserve Chairman, ending a prolonged odyssey that has seen unprecedented turmoil around the central bank. The decision culminates a process that officially began last year, but actually started much earlier than that, with President Trump launching a barrage of criticism against the outgoing chairman. The choice of Kevin Warsh did not rattle the markets, mainly because of his past experience at the Fed and Wall Street's view that he would not always do Trump's bidding. According to major market players, he has the respect and credibility of the financial markets. And on economic growth, according to an estimate from the Commerce Department, the U.S. economy grew at a faster pace than expected in the third quarter of 2025. On Thursday, the Bureau of Economic Analysis released its final reading for the third quarter GDP, which showed that in the third quarter of 2025, the U.S. economy grew at an annualized rate of 4.4%. This rate of growth exceeded market expectations as economists polled by LSEG had estimated a GDP growth of 3.3% in the third quarter of 2025. The report also showed that GDP rose at an annualized rate of 3.8% in the second quarter, which followed a contraction of 0.6% in the first quarter. Taken together, the three readings for 2025 indicate that the U.S. economy grew at an annualized rate of 2.5% in the first three quarters of 2025. According to the Bureau, the growth in GDP was driven by an increase in consumer spending, exports, as well as government spending and investment. And a quick update on the largest sovereign wealth fund. Norway's sovereign wealth fund, with $2 trillion in assets under management, posted an annual profit of $247 billion in 2025, and this was mainly due to a rally in tech, financial, and mining stocks. The fund, which was set up in the 1990s with the aim of investing excess revenues from Norway's oil and gas industry, this fund is currently invested in more than 7,000 companies across 60 countries. In the foreign exchange market, safe haven assets such as gold are off to a good start in 2026, but that includes safe haven currencies such as the Swiss franc. The Swiss franc has already gained 3.5% against the US dollar so far this year, driven higher by unpredictable US trade policy as well as concerns about the independence of the Federal Reserve and the threat of American military interventions in Greenland, Latin America, and the Middle East. The Swiss franc strengthened by about 12% against the greenback in 2025, and on Tuesday this past week it touched an 11-year high against the dollar. Switzerland's policy of neutrality, combined with a robust economy, a low national debt, and a stable financial system, makes the Swiss franc a global safe haven asset. And whenever there is uncertainty in the world, investors rush into the Swiss franc, causing the currency to appreciate, and this makes monetary policy more complicated for the Swiss National Bank. On Wall Street this past week, stocks retreated on Friday as technology shares remained in limbo, even as investors largely approved of President Trump's pick of Kevin Warsh to lead the Federal Reserve. However, despite Friday's losses and volatile trading, the S&P 500 still managed to record a marginal gain in the month of January. Kevin Warsh's selection as a Fed chairman is likely to ease concern about the independence of the Federal Reserve, mainly because of his experience as a Fed governor and his strong stance at times against inflation. Whilst he is likely to push for lower interest rates in the short term, the financial markets view him as someone who would not always follow the president's direction and can maintain the credibility of monetary policy. On Friday, the broad market index, that is the S&P 500, fell by 0.43% to close the day at 6,939, and the Dow Jones Industrial Average pulled back 179 points to settle at 48,892, whilst the tech-heavy Nasdaq Composite underperformed, dropping by 0.94% to end the week at 23,461. In the government bond market, U.S. Treasury yields held steady on Friday after President Trump named Kevin Warsh as his pick to be the next chairman of the Federal Reserve. Trump's decision to nominate Warsh, who is a former Fed governor, dominated investor sentiment, ending a months-long process that began last year, in which we saw the president continuously criticizing the outgoing chairman for not lowering interest rates quickly enough. In response, we saw the yield on the 2-year Treasury note slide by about 2 basis points to close at 3.53%, whilst the yield on the benchmark 10-year Treasury bond rose by about 2 basis points to settle at 4.25%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil dipped a few cents per barrel on Friday, consolidating recent gains and holding near 6-month highs, supported by persistent tensions between the United States and Iran. On Thursday, oil prices hit their highest levels since early August 2025, with multiple sources indicating that President Trump was considering actions against Iran that included targeted strikes, raising concerns about disruptions to oil supply. The focus right now is on Iran, with markets pricing in a lot of geopolitical risk as they contemplate whether the U.S. will launch targeted strikes, and if they do, the key question is how Iran will retaliate. In response to the foregoing, the price of the global benchmark Brent crude was broadly flat at $70.69 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this dipped by 21 cents to close the week at $65.21 per barrel. In the precious metals market, the price of gold and silver plunged on Friday as President Trump nominated Kevin Warsh as the next chairman of the Federal Reserve. This nomination appeared to relieve concerns about the central bank's independence and sent the US dollar soaring against safe haven assets like gold. The sharp moves down were initially triggered by the nomination of the next Fed chairman as investors raced to book profits on gold and silver. Precious metals also came under pressure as the US dollar appreciated against other assets, making it more expensive for foreign investors to buy gold and silver. In response, the price of spot silver plummeted by 28% on Friday to close at $83.45 per ounce. On the other hand, the price of spot gold was down by about 9% and was last seen trading at $4,895 per ounce. In the cryptocurrency market, the price of Bitcoin slumped on Friday as retail traders assessed the wild swings in commodities, plus the long-awaited nomination of the next Federal Reserve chairman. The slide in crypto comes in the wake of Trump's selection of Kevin Warsh to lead the Federal Reserve. This move supported the US dollar as it eased concerns about the central bank's independence, and as the dollar appreciated, it reduced the appeal of Bitcoin as an alternative currency. Bitcoin is down by 4% so far this year and is 19% lower over the past 12 months. And as the markets closed on Friday, the price of Bitcoin was down by more than 6% as it sunk below $79,000 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, as headline inflation declined marginally to 4.4% in January 2026, down marginally from 4.5% in December 2025, and this was largely on account of moderation in non-core inflation. Non-core inflation measures the price changes for volatile food and energy items, and this declined from 11.6% in December 2025 down to 10.3% in January 2026. The decline in non-core inflation was mainly driven by a moderation in the prices of select food items. Meanwhile, core inflation, which excludes volatile food and energy prices, this increased from 2% up to 2.2% over the same period. In the domestic foreign exchange market, the Kenya shilling remained frozen in time versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at a rate of 129.03. Meanwhile, the sterling pound was priced at 177.78, and the euro was valued at 154.38. And on the regional front, one Kenya shilling was changing hands for 27.74 Ugandan shillings and 19.84 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.27. The IMF has raised concerns about the extreme stability of the Kenya shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased significantly by $115 million for a grand total of $12.33 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.99% and remained in sync with the central bank rate at 9% flat. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 6.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 29th of January, and the central bank received bids totaling to 47.2 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 196%. The central bank ended up accepting almost the entire amount, taking up 47.1 billion shillings, and the results of the auction were as follows. The 91-day rate dropped sharply by more than 9 basis points to settle at 7.63%, whilst the 182-day rate ticked up by less than 1 basis point to hover at around 7.80%, and the 364-day rate continues to remain unchanged at 9.20%. In the primary bond market, the Central Bank of Kenya has published its prospectus for its February Treasury bond issuance, in which it is looking to raise a total of 50 billion shillings for the stated purpose of budgetary support, and this will be done through the sale of 2 fixed coupon Treasury bonds whose terms and conditions are as follows. The first bond is a 15-year bond that was initially issued in 2019 and now has 8.4 years left to maturity. This bond has a coupon rate of 12.34%. The second bond is a 25-year bond that was initially issued in 2018 and now has 17.3 years left to maturity. This bond has a coupon rate of 13.40%. Both bonds are now open for sale until Wednesday, the 11th of February, when the auction will be held. On Kenya's latest credit rating, Moody's rating has upgraded Kenya's sovereign rating to B3 from Caa1, citing a sharp fall in near-term default risk after stronger foreign exchange reserves, as well as a successful Eurobond refinancing and improved access to both external and domestic funding markets. According to the Moody's rating, the upgrade covers Kenya's local and foreign currency long-term issuer ratings and foreign currency senior unsecured debt, with the outlook revised to stable from positive. Moody's said easing balance of payments pressure and improved funding flexibility have reduced immediate credit stress, though weak debt affordability and persistent fiscal deficits continue to constrain the country's credit rating. The Moody's upgrade comes just 1 week after Fitch Ratings affirmed Kenya's credit rating at B negative with a stable outlook, citing improved near-term external liquidity after a sharp rebuild in foreign exchange reserves and recent liability management operations, whilst warning that fiscal stress and high debt service cost continue to constrain Kenya's credit profile. Up next is our topical issue, and this week we are looking at the debt for food security swap. The Treasury will use proceeds from the $1 billion debt for food security swap to make early repayments on outstanding and expensive Eurobonds in order to ease Kenya's heavy debt burden. So what on earth is a debt for food security swap? In December 2025, Kenya and the United States International Development Finance Corporation agreed to a $1 billion debt for food security swap, aiming to restructure high-cost short-term debt into cheaper, longer-dated financing. This arrangement frees up fiscal space, allowing Kenya to invest savings directly into agricultural infrastructure and food security. The details of the agreement were as follows, where the deal acts like a debt for nature swap, where the DFC-backed guarantee allows Kenya to refinance, with the savings potentially up to 35% being ring-fenced for food initiatives. The purpose of the agreement is to alleviate severe debt servicing pressure whilst targeting investments in irrigation, climate-smart agriculture, and national school feeding programs. The significance of this agreement is that it's part of a broader strategy by the Kenyan government to manage sovereign bond repayments and reduce the cost of living. And in terms of background, the deal emerged from discussions between the Treasury and the DFC, reflecting a trend towards utilizing development-linked financing for critical sectors. The debt for food swap is expected to work similarly to the debt for nature swaps that have been implemented by several countries in recent years and which offered lower interest rates in exchange for the protection of nature. This debt for food security swap is considered a landmark deal for Kenya and provides a model for other African nations to manage debt whilst funding sustainable development goals. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhurrijin@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the word loneliness expresses the pain of being alone, whilst the word solitude expresses the glory of being alone. A quote by Paul Tillich. Think about it. Thank you, and God bless.